Question: if I sell a rental property or a highly appreciated stock, will that massive capital gain push my regular income into a higher tax bracket and cost me more in ordinary taxes? Answer: no. Long-term capital gains are taxed on a completely separate schedule, and they do not increase the tax rate on your ordinary income, things like your wages, your pensions, or your IRA withdrawals. However, they do increase your adjusted gross income, and this is where many people get surprised. I'm Adam Olson, a CFP, and I've used my 14 years of experience to create the Red Zone retirement planning process so that your retirement feels like a Saturday every day. So let me explain to you how this all actually works. I want you to think of your taxes as two separate buckets. Bucket number one is your ordinary income. This includes your wages, interest, your pensions, and your IRA withdrawals. That income is taxed using the normal progressive tax brackets that you're used to, 10, 12, 22, and so on. Now, bucket number two over here, this is your long-term capital gains bracket. That's profit from stocks, real estate, or businesses that you've held longer than 1 year. Now, these gains are taxed on a completely different rate schedule entirely. Here's the key rule that most people misunderstand. Your capital gains actually stack on top of your ordinary income, but they do not push your ordinary income into a higher tax bracket. So let's just say you're in the 12% ordinary income tax bracket and you sell a stock with a large long-term gain. Your original income is still taxed at 12%, but the gain is taxed completely separately. Now, let's talk about an opportunity here in 2026 for married filing jointly couples. The 0% long-term capital gains rate applies to roughly $98,900 worth of your taxable income. This means if you do it correctly, you could sell appreciated assets, stocks, rental properties, you name it, reset your cost basis, and pay nearly 0% in federal capital gains tax. This strategy, called tax gain harvesting, and it's one of the most powerful moves available if you're early in your retirement. But there's a catch. Even though your tax bracket doesn't change, your adjusted gross income goes up. And that could potentially trigger higher costs, so you have to be very careful if you're doing this on your own. The first cost it could trigger is Medicare IRMAA surcharges. A large gain today can raise your Medicare Part B and D premiums in the future, 2 years down the road. Second thing, the net investment income tax. If your AGI exceeds $250,000 married, you may owe an extra 3.8% surtax on investment income. And third, state taxes. Some states like California tax capital gains the same as your ordinary income, which removes the federal advantage. This is why understanding how these two tax buckets interact is very critical for you. When you plan correctly, you can harvest gains, execute Roth conversions, sell real estate, and avoid these tax cliffs, all without fear-based decisions. This is real retirement control. And if you've made it this far, I want you to click the link in my bio. Take the How Much You Need to Retire quiz. After you fill it out, I'll personally send you a video applying my Red Zone retirement planning process to your exact situation.